Welcome back to our third episode in our Model 51 breakdown series. Today we're going over how we analyze the higher time frames and get our bias.
So we use three different time frames in our model. So first we start off on the daily to determine a bias, then we drop down to the hourly to figure out a narrative and where price wants to go. We'll mark out swing points, liquidity points, resting highs, equal lows, and all of that. And finally, we'll just drop down on the 5 minute or 1 minute to catch an entry. A note to self would be that price is always doing one of two things. It is either rebalancing an FVG or reaching for swing highs and lows. That's basically just the core of how we trade.
Okay, so here in this first example, what we're going to see is price going from external to internal liquidity. So here on the daily, we have a candle taking out external liquidity, which takes the form of a swing low, and now we expect it to rebalance the imbalance above, and that's exactly what it does. So I believe that's a new week opening gap, maybe, depending on what day it is. So now that we see price in internal liquidity, we expect it to go to external liquidity, which now takes the form of a swing high. So we should expect price to expand upward. Okay, so given this expansion, what I want you to look at is the small FEG that was created after price took out the external liquidity. So right there, because we are bullish on the day, we want price to go into that FEG and then take along from the lower time frame. So given the candle that comes afterwards, we see a huge rejection off of that FEG. So it probably gave us a great entry on the lower time frames.
So that was a quick step by step on how we get our bias, but none of this really matters unless we time our entries right. That's why narrative on the intermediate time frame is key. So in this next video, we'll break down how we time executions using structure on the hourly and the 15-minute in order to get sniper entries. So look forward to the next video. We'll see you then.